Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be studying one question of marginal costing based on decision making. Let us read the question. A retail dealer in garment is currently selling 24,000 shirts. So they have given the current output, that is 24,000 shirts are sold annually. He supplies the details for the year ended 31st December 2013. Selling price per shirt is given 40 rupees. Variable cost per shirt is given 25. Fixed cost, staff salaries for the year 1. Amount is given 1,20,000. General office cost for the year 80,000. That is information of office overheads. Advertising cost for the year 40,000. That is the third information about the fixed cost. As a cost account of the firm, you are required to answer the following each part independently. That is what is asked in the question. So there are 4 sub questions are there. We'll consider one by one. First, calculate the break-even point and margin of safety in sales revenue and number of shirts sold. That is the first sub question we are having. Let us start with this. Contribution per unit is sale price minus variable cost per unit. Sale price here we have 40 rupees and variable cost per unit of shirt is 25 rupees. Sale price 40 rupees. Variable cost 25 rupees. So here we got contribution per unit 15 rupees. With this we can proceed to calculate PV ratio. PV ratio is equal to contribution divided by sales multiplied by 100. Contribution here we have 15 rupees. Selling price is 40 rupees multiplied by 100. So we got PV ratio 37.5%. This is the first information we got. PV ratio we have calculated 37.5%. Next we are required to calculate break-even point. Break-even point sale in units. Formula is fixed cost divided by contribution per unit. In question, they have given 3 fixed costs. Staff salaries 1,20,000, office cost 80,000 and selling 40,000. So we are required to add all these 3 values to arrive at total fixed cost. Divided by contribution per unit, that we have already calculated 15 rupees. Let us add this 1,20,000 plus 80,000, 2 lakh plus 40,000, 2,40,000 divided by 15. So break-even point in units we got 16,000 units. Now we are required to calculate break-even point sale in rupees. We can calculate this based on break-even point in units multiplied by selling price. Break-even point units we have calculated here 16,000 units multiplied by sale price. Sale price we have rupees 40. So break even point in rupees would be, it will be 6,40,000. So we have calculated PV ratio, break even point in units, break even point in rupees. Next they have asked margin of safety. Very first line of the question says that there is sale of 24,000 shirts, that is units sold actually, and the selling price is rupees 40. Units sold 24,000 units, selling price is rupees 40. So actual sales we got 9,60,000. We are required to calculate break even point sales. We are required to calculate margin of safety. Formula is actual sales minus break even point sales. Actual sales we have calculated here 9,60,000. Break even point sale in rupees we have calculated 6,40,000. This 6,40,000 will be deducted from here. So we got margin of safety 3,20,000. We have calculated all required values. Sub question 1 we have done, that is break even point margin of safety we have calculated. Now let us proceed to sub question 2. Sub question 2 says that assume that 20,000 shirts were sold. So first line of the question says 24,000 shirts sold. So here there is a change now. They say that 20,000 shirts were sold in a year. Find out the net profit of the firm. If there is sale of 20,000 shirts, we'll try to find out sales in rupees. Formula will be units sold. Units sold multiplied by sale price. Units sold, they have given here assumption 20,000 shirts. Sale price is given in the question rupees 40. So your sale amount will be rupees 8 lakhs. We got amount of sales. Now we are required to find out the amount of net profit. So we'll try to find out contribution at this sales level. Formula is contribution is equal to sales multiplied by PVR. PVR already we have calculated. It is 37.5%. It will be applied here now. 8 lakh multiplied by 37.5%. So we got contribution rupees 3 lakhs. Question says that we are required to find out the amount of net profit. Net profit is equal to contribution minus fixed cost. Contribution already we have calculated 3 lakhs. See, there are 3 items of fixed cost that we have added here while calculating break even point in units. 1,20,000 plus 80,000, 2 lakh plus 40,000, that is 2,40,000. So from 3 lakh we will be deducting 2,40,000. Finally we get amount of net profit 60,000. at sale level of 20,000 units. We have completed sub question 2. Let us start with sub question 3. If it is decided to introduce selling commission rupees 3 per shirt, that means for every shirt sold there will be payment of rupees 3 commission. So it becomes variable cost, because for every new shirt, for every additional shirt sold, we are required to pay commission of 3 rupees. How many shirts would be required to be sold in a year to earn net profit, net income of rupees 15,000? Current selling price is 40 rupees and variable cost per shirt is 25 rupees. Current variable cost is 25 rupees. Sales commission added 3 rupees. So revised variable cost will be 28 rupees. Now we can calculate revised contribution. Revised contribution is equal to sale price minus revised variable cost. There is no change in sale price. Sale price will be 40 rupees. Revised variable cost 28 rupees. So revised contribution is 12 rupees. We can calculate now revised PV ratio. Formula is contribution upon sales multiplied by 100. Contribution we got 12 rupees. Selling price 40 rupees multiplied by 100. So revised PVR is 30%. So we got revised PVR. Now we'll try to find out how many units will be required to be sold to make net profit. Net profit required here, it is given 15,000. Net income required profit 15,000. Formula is fixed cost plus required profit divided by PVR. Fixed cost will be total of 3 items which are given in the question. 1,20,000 plus 80,000 plus 40,000, that is 2,40,000. Fixed cost 2,40,000. Required profit given in the question 15,000 divided by PV ratio that we have calculated now 30%. So it comes 8,50,000. Required sale will be 8,50,000 to make profit of 15,000. We can also find out required units to be sold. It will be based on required sales figure of 8,50,000 divided by selling price, which is 40 rupees per unit. So it comes to 21,250 units to be sold. So this is how we have also completed this sub question. Sub question 3 is completed. Now last sub question 4. Assuming that for the year 2014 an additional staff salary 33,000 is anticipated Here anticipated means expected. So there will be more fixed cost by 33,000 rupees and the price of shirt is likely to be increased by 15%. That means current price will increase by 15% next year. What should be the break-even point in number of shirts and sales revenue? So last question is asking about the break-even point. Let us start now. Sub question 4. Assuming that for the year 2014 an additional staff salary rupees 33,000 is anticipated. So there will be more fixed cost in relation to office salary and price of shirt is likely to be increased by 15%. So there is also change in amount of selling price. What should be the break-even point in number of shirts and in sales revenue? Let us first calculate revised fixed cost. So revised fixed cost will be staff salaries, already we have 1,20,000. Additional new salaries will be paid 33,000. So total staff salaries will be 1,53,000. Office overheads have remained same 80,000. Advertisement overheads have remained same 40,000. So we will be adding all these costs. So revised fixed cost we got 2,73,000. Current sale price given in the question is rupees 40. They say that there will be increase in selling price by 15%. So we are required to add 15% to sale price. So it comes to 6 rupees. 40 plus 6. So revised sale price is rupees 46. We can further calculate now PV ratio. Formula is contribution upon sales multiplied by 100. Revised selling price is 46. There is no change in variable cost. Variable cost per shirt will remain same, that is rupees 25. 46 is revised selling price. Variable cost rupees 25 divided by sale price 46 multiplied by 100. Let us calculate the value. So it comes to 45.65%. So we got the profit volume ratio 45.65%. Let us proceed to calculate now break even point. Break even point in rupees will be fixed cost divided by PVR. Fixed cost we are required to take revised 2,73,000 divided by PVR, that is 45.65%. So break even point in rupees will be 5,98,028 rupees. This we got in rupees. We can also calculate break even point in units. Formula is fixed cost divided by contribution per unit. Fixed cost we have 2,73,000. Revised selling price is rupees 46. No change in amount of variable cost minus 25. So it comes to 13,000 units. So we have learned how we can take various decisions using marginal cost techniques in this question. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.